What happened to Vanguard? Vanguard has had a huge and positive impact on the investing world over the past 50 years since it was founded by John Bogle. Bogle did something great for us regular investors by bringing low-cost investing to the masses. It all started in 1974 when Bogle founded the Vanguard Group and pioneered the first index fund available to the public. The idea of an index fund was pretty revolutionary and unusual at the time, because the industry was all about actively managing funds, picking stocks, and trying to determine the best time to buy and sell them. Bogle's index fund was different. The fund would own all the stocks in the Standard & Poor's 500 index. It would not pick and choose the best stocks or the worst stocks. It would own them all in proportion to how big the companies were, and again following the index. The idea of index investing did not go over well at first. Of course, investment firms and investment managers were reluctant to give up their control and those higher fees that they were charging. Index funds, because they are passive, don't need expensive fund managers making decisions, so they are naturally low cost as well. The other unique thing about Bogle's Vanguard Group is the ownership structure. Shareholders own the funds, and the funds own Vanguard. Therefore, the shareholders, in an indirect kind of way, own Vanguard. With this arrangement, interests are aligned between you as a shareholder and Vanguard as an investment firm. Now, it all sounds great in theory, but in practice, I don't think it actually means anything to you as an investor. One could argue that this unique ownership structure helped Vanguard push fees lower and lower. They didn't have anyone breathing over their shoulder trying to squeeze out more profits. And perhaps this is true. And if so, it worked, because here we are with fees at rock bottom prices, even zero in some cases, and low fees are basically everywhere. And that's precisely why it might be time to jump ship from Vanguard. It might be time to say, thanks for what you did, Vanguard, but I've got to go now. And Vanguard does deserve thanks, because it's led this low-cost and passive investing revolution in the investing world. It took time, but passive index funds eventually swelled in popularity as individual investors slowly got the memo. That is, active funds usually underperform a simple indexing approach, especially due to their higher fees. Active funds tend to drag down the returns of a portfolio, and they are less efficient from a tax perspective as well. By some estimates, 80% of all active funds underperform in a given year. That means 20% outperform. The problem is, it's very difficult to predict ahead of time which 20% might outperform ahead of time. So the best approach for the long term is to stick with a low-cost, diversified, passive index approach, and that is the Vanguard way. But Vanguard itself has changed a lot since Bogle stepped down in 1999 and after he passed away in 2014. There's been a series of new leadership at Vanguard, of course, and during this time ETFs have really grown in popularity, slowly displacing Bogle's preferred mutual fund structure. Mutual funds have been Vanguard's bread and butter historically, and in this time, Vanguard has grown very big very quickly. Yes, word spread about Vanguard's low-cost approach, and now they have nearly $8 trillion in assets under management. Only BlackRock has more assets under management. Vanguard is the largest provider of mutual funds and the second largest provider of ETFs in the world, and it's considered one of the big three along with BlackRock and State Street. But now you can get low-cost index funds just about anywhere, including at Vanguard. And Vanguard's bread and butter, which have been those mutual funds, have historically been run very efficiently, and they are a great place to invest for the long term. But mutual funds are steadily being replaced by ETFs across the industry, including at Vanguard. And the ETF version of Vanguard's funds are just as good as the mutual fund versions. They are managed just as efficiently, and they are effectively exactly the same product, just with a different wrapper that allows it to be traded throughout the day, in the case of the ETF, versus just at the end of the day, as is the case with a mutual fund. So Vanguard's index ETFs continue to be excellent investment products. They're low cost and very tax efficient. But now you can buy them from just about any brokerage for the same exact cost as buying them directly through Vanguard. Now, Vanguard does have that unique mutual ownership, which is a cool story, but also, so what? You can get all the investment benefit that you want through the ETFs, and if you don't need to go to Vanguard to get Vanguard funds, then all that's left is the technology and the customer support. And Vanguard has gained a reputation for being terrible in both of these areas. First of all, their website seems straight out of the 90s. Some pages have a modern look and feel, but not all of them, so the experience is not only dated, but inconsistent. It's very difficult to find what you need on the site. Menus are all over the place and disorganized. You never know where to find a specific feature. There's just friction everywhere. And their mobile experience is not much better. Some features like buying and selling options are technically possible, but the experience seems so difficult that I've never even considered trading options on Vanguard's platform. And lately, their website is getting even worse with annoying pop-ups like this one interrupting sessions. Now, I don't want this to turn into a full-on personal rant about Vanguard's website, so I'll leave it there. Clearly, Vanguard has technology and user interface issues. But what about the customer support? Well, apparently there are issues there as well. I must admit I've only had to contact Vanguard once for customer support in the decade or so that I've been using it, and that experience was fine, but apparently it's a disaster for a lot of other people. And I think this Redditor best summarized the frustration.
Vanguard customer service is the worst. Vanguard customer service sucks donkeys behind. They should just offload the service offshore. When they can't fix a website problem, they just hang up. I'm on the verge of moving out to Fidelity. Hope their customer service is better.
Others describe being on hold for hours, whereas Vanguard used to pick up after 3 rings. It doesn't sound good. Even as a do-it-yourself investor, well, as I move into retirement, I would imagine there will be more times where I will need to pick up the phone and contact Vanguard for questions and help. Now, if customer service at Vanguard has indeed gone completely downhill, well, then it's probably due to their sheer size. BlackRock has more assets under management, but they deal mostly with institutions and financial advisors, whereas Vanguard has this retail brokerage where they're dealing a lot with the end consumer. So Vanguard deals with public investors directly, as well as institutions, but I suspect they've grown faster than their internal systems can keep up with. And maybe they've had trouble attracting and retaining talent. Well, that's just speculation on my part, but I could imagine that being the case. What matters is that their customer service has a reputation for sucking donkeys behind, and who wants to deal with that? Now, aside from their technology and customer service issues, Vanguard has gotten itself into controversy for its role as a major proxy shareholder voter. Instead of each fund shareholder voting on corporate shareholder decisions, Vanguard acts as a proxy and votes for us. This is not a new situation, but it's received a lot of attention recently. These proxy votes can influence the direction of corporate governance and the directions that corporations move when it comes to politically sensitive topics like diversity, equity, and inclusion, workers' rights, and greenhouse gas emissions, just to name a few. The whole thing doesn't sit well with some investors. It seems to them that Vanguard, along with the other big 3, are getting too involved in political issues or leaning the wrong way politically for their tastes. In response, Vanguard has started a program which gives investors more of a direct say in proxy voting, and that's for shares that they own in portfolio companies. But it may be too little too late for many investors who are now avoiding Vanguard or actively running away from it. And it's not just customers that are running away from Vanguard's troubles. Vanguard announced in February of this year that Chief Executive Officer Tim Buckley will retire by the end of the year after a 33-year career, including more than 6 years as CEO. Now, I don't know if this will end up being good news or bad news for retail investors, but I would bet that a shakeup in leadership will be a good thing in the long run. But we don't have to wait around to find out. The good news is that investors are no longer stuck. They can take their precious Vanguard index funds and own them somewhere else. And they can do this without any downside that I can identify. They're not stuck with Vanguard just because that's where the low-cost funds are. Now the low-cost funds are everywhere. There's no reason we can't have it all. We can shop around for the best brokerage that meets our expectations for technology, service, and investment options. Whether it's Schwab, Fidelity, or new kids on the block like Robinhood or Webull. We can own Vanguard's best ETFs in any of these places. We can have the technology and customer experience that we want and still own the best in class in Vanguard's index funds as ETFs. One thing that I would miss if I was to move away from Vanguard's platform are the money market funds, and you can learn more about that in this video right here.